in terms of the earnings season, we're looking for a confirmation of, number one, the strength of the economy and how that's translating into performance for the market. And what we're seeing now is the results are coming in quite strong, and they are doing spectacularly well for tech companies, which is what we want to see. It's an area that we remain really encouraged by.
So it's technology, it's communication services, it is those mega cap stocks that have been driving the action. We're talking about 20, 30, 40% returns for some of the biggest companies in America. Is that the situation that's going to continue for the rest of this year, even with the specter of more regulatory scrutiny from Washington, D.C.?
We continue to see tech leadership for the foreseeable future. And really what it comes down to is just how solvent and how strong these business models truly are. When you're in an environment where earnings are growing double digits, that's really the baseline for the return at which you have to judge. We can determine how much some of those companies are worth, but businesses growing 20% or double digits are being rewarded with that. Has
it surprised you, the market resilience? I mean, granted, we had one of the worst fourth quarter performances we've seen in years leading into, the bottoms on December 24th, Christmas Eve. But since then, it's been off to the races and record highs again. Has it caught some people off guard?
I think those people who are looking at the performance year to date, and to your point, the fourth quarter was quite bad. Year to date, we're seeing a very strong return for the market. I think it's important to put that in the context, though. When we look at it from, let's say, the September highs, the return that we're seeing is actually relatively normal. We're up 5% or so since then. So I think it depends upon the time frame at which you're looking at it. And taken sort of throughout the dip and the recovery, the return looks quite normal. And I think investors should keep that in mind to say that 20% seems strong, yes. But if I look at it over a longer period of time, it doesn't seem that out of ordinary.
Does the underlying economy in the United States justify the types of equity valuations that we are seeing right now?
So the U.S. economy, I think, is doing very well. It is decelerating, but it's decelerating in a rather benign manner. We're not going into a recession. I think that's important because recessions are problematic for risk assets and equity specifically. In terms of valuations, we actually look at the valuation for the market as undervalued. And I think really what it is, investors typically think of the market in terms of PEs, but it I say underappreciates how efficient these companies have become over the past decade. They've become less capital dependent. They've generating significantly more free cash flow. So when you look at it on a more complete measure, on a price to free cash flow basis, the market looks roughly 10 to 15% undervalued.